Hey, Jason here. Today's video, I'm going to answer the question, should you invest in NIO, electric vehicle maker NIO? We're going to do a stock analysis of them today. Before I get to that, though, I need to let you know that you can get this series as a podcast anywhere for free on all major podcasting platforms, Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. Make sure to stick around for the ends of the video as well, and I'll tell you how to get some free resources that help you become a better investor faster. Okay, again, I apologize for this long preamble that I'm about to do, but every time I forget to do it, I get nasty, to put it nicely, in comments in the comment section. So again, I apologize for this, but I apparently have to do this or people are going to get ridiculous. So this is for informational purposes only. I do not own any stock in any company that I talk about, and I do not short sell. So I don't short sell any stock in any company that I talk about. This is going through my valuation and analysis procedure, and this is to help you learn how to become a better investor faster by learning how to spot things faster, better, more efficiently, and more importantly, to spot the important things, the important red flags, the important positive things. Why should you listen to me? In the first 9 years of my career, in the last 9 years, I've produced average returns in the portfolios I manage of 23.55% per year on average, which in the first 9 years compared to Warren Buffett's career, he produced, I think it was 24.2, so I'm right behind Buffett, and those numbers legitimately make me one of the best stock pickers in the world. I'm not saying that to brag, I'm saying that to give you context into why you should listen to anything I have to say, because why should you have to listen to anything anyone says on YouTube? That's to give you some context as to why I actually know what I'm doing, and again, I'm doing this to help people. I'm not doing this to make money off short selling or long selling or long buying. Sorry, I don't do either for any company I talk about. So again, I apologize for that long preamble, but I have to put it in there. Okay, today we're going to cover NIO, electric vehicle company ish. I'll get to the ish part in a little bit. NIO. Okay, let me go to here. If this is your first time watching any of our investment analysis videos, I will probably reference at some point some of the videos that I've done in the past on certain companies. For example, if I talk about things like book value, impairments, intangible assets, stuff like that, I'll reference certain videos. All of the videos are available that I've done in this series are available below this in the description for free. And those specific videos that I mentioned will be below this as well. Okay. NIO. First thing I mentioned or I notice here is they don't have a PE ratio, which likely means they're not profitable. This is forward PE, so there could be some nuances here, but this is a sign the company might not be profitable. Price to sales is gigantic. I don't use price to sales ever, really, but I do know what a typical price to sales metric is, and that is a massive valuation metric right there. I have done a little bit of research on NIO before, so I'm going to go over what it is a little bit. They make, or they're planning to make, excuse me, I'm getting two companies confused. They do make electric vehicles over in China. Their market right now, I think, is only China, while Tesla operates worldwide and some of the bigger car companies worldwide or operate worldwide. Sorry, I'm getting distracted. I can hear my dogs barking. Hopefully you can't hear that in the video. If you do, I apologize for that. Okay. Revenue. Looks like the IPO probably in 2018 is my guess because they have most of the information there for 2018 when in the past they do not. Okay. They are incredibly unprofitable on an operating profit basis. In the last 4+ years, they produced negative 20, 25, 30, $25-ish billion CNY. That's yuan or Libby. I'm not sure how you pronounce it. That is not good. Their operating margins, again, I look for anything above 10% on a consistent basis, positive 10%. This is negative 194% rounded up in 2018, negative 142% rounded up in 2019, and negative 52% in the trailing 12-month period. What that means, to illustrate this, is that in 2018, for every $1 in sales this company produced negative almost $2 in operating profit. So it spent essentially $1 to lose $2. Or in another sense, it just spent $3 for every $1 it spent. Not good, again. They issued a ton of shares in 2018. Again, I'm assuming they went down a lot in 2016, 2017 from 848 million to 2018 at 332 million. And they issued about 700 million shares in 2019, it looks like. Dilution is not good, typically, unless the stock is overvalued, which I can almost guarantee this company is, because it has an $80 billion plus value market cap, and it has, in the entire history of the company, produced 25-ish, no, sorry, yeah, no, that's about right, 25-ish billion dollars worth of revenue in renminbi, in yuan. Again, I apologize for not saying that right, which is to USD, checking out the exchange rate. So 25 billion. So they have an $81 billion market cap in US dollars, and they've only done about just under $4 billion in US dollars in revenue over the entire course of their history, of their public history at least. So again, I can tell immediately if this company is massively overvalued. I also know that because they're in the EV space, and most EV companies are massively overvalued, but this one might be an extreme case. Okay, operating cash flow massively negative in the billions of dollars. Free cash flow, same thing. ROIC, hugely negative. This is interesting. ROIC in 2019 was negative 155%. This is a more interesting thing, though. Their ROE is negative 314% in the last 12 months, while their ROIC is negative 53.4%. That means, because ROE is higher than ROIC, that it has a significant amount of debt. I can tell that because ROE is levered by debt, while ROIC is not. So this shows the company has a significant amount of debt, which is further negatively leveraging, in this case, its margins. ROIC, or free cash flow to sales, again, negative 213% 2018, negative 133% 2019, negative 15% in the last 12 months. Good thing is this company looks like it's heading into the right direction, and it's getting closer to profitability. 2018 and 2019 were rough. 2020 and beyond is still rough, but not horrifically bad for NIO. Okay. Nothing major is catching my eye here, except for these long-term liabilities. Negative 276% of it, or 276% of the balance sheet in 2016, and 189% of the balance sheet in 2017. I'm assuming these are long-term liabilities, like might be licensing agreements for EV tech. My guess is, because it looks like they IPO'd in 2017 or 2018 from the looks of these financials, that these are related to funds from the IPO, things like stock options, restricted stock units, stuff like that would be my guess. That led to negative book value for most of the last, or since 2016, which essentially means, again, I covered this in some of the other videos, which essentially means that the company's book value, total assets minus total liabilities. The company has more total liabilities, meaning, and since that is a proxy for share price or the share value, that means that the company's shares are essentially worthless. Again, it's not a apples to apples comparison as much as it used to be, but it matters more here because this is a hard asset company. This number matters more for hard asset companies, which as a car manufacturer this is. Negative cash conversion cycle, good to see for them. Again, I covered this in other videos, and I cannot, might have been Archer's Daniel Midland video that I talked about that significantly, but I can't remember for sure. That video is below this, but negative here, typically that's a good thing because it's earning money or it's making sales faster than it's having to pay its suppliers. That's typically a good thing. Okay, first thing here, negative interest coverage ratio. That is not good. I've talked about this in several videos now. This means that the company can't cover its current interest on its debt payments with the earnings with its net income, which obviously makes sense because it's negative profitability on net income, which is also known as earnings basis. So this is obvious, but what it also means is to stay alive, because the company is unprofitable, has to most likely issue more shares and or more debt. In this case, it's definitely been more debt because the debt level has gone up, which we're about to see. Oh yeah, just in the last, so, oh, that's going backwards. Okay, so let's go in here. Let's go, that works. Okay, so they have a ton of cash. They have $22 billion in cash, 22 billion CNY in cash, sorry. That has come from issuing debt and shares, which again, typically share dilution is bad, unless the company is overvalued, which in this case, the company is overvalued. Again, as I talked about earlier, I know that because I've evaluated this space, and also because of the price to sales and some of the other stuff I went over in the earlier part of the video. Nothing really major sticking out to me here. Debt levels are actually lower than they were in quarter 3 2019, which is a bit surprising compared to what its ROIC and ROE. I figured there'd be a lot more debt than that based on the difference between those two numbers. That's what it is. Okay. Okay, so this makes more sense now because they're issuing preferred stock instead of debt. So preferred stock, this is the first time we're talking about this because preferred stock doesn't come up very much anymore. It used to come up earlier or a long time ago, decades ago. Preferred stock doesn't come up very much anymore. So what preferred stock is, in essence, is it's a hybrid kind of debt and stock instrument. Typically preferred stock, and again, it depends on the terms of the preferred stock agreement, but typically this is a stock that has a preferred position in a bankruptcy situation ahead of the regular shares, plus they also usually get some kind of dividend. So it's in between, in like a bankruptcy, think of a bankruptcy situation. Debt comes first as people who are getting paid. Stock comes left if there's anything left over, which typically there isn't. Preferred stock comes in between both of those. And again, typically there's a higher, pretty high dividend usually actually, on preferred stock that goes to shareholders. So that makes more sense on why the debt in essence is lower, but they've been raising money by issuing preferred stock. So let's go. Again, this is the same process I would go through anytime I look at a company. I would look to see what the terms are not showing me. It's not showing me. Okay, here's an SEC doc. Let me zoom in here. This is about American Depository Receipts. They're offering 160 million new ADSs to raise money. An ADS is essentially the same thing as an ADR, American Depository Receipt. These are when foreign listed companies want to list their shares on a foreign stock market. Most of the time, it goes on these listings go on the or the counter or the pink sheets. The reason foreign companies do this is because the U.S. is I think it's still by far the largest stock market in the world. So they want to float their shares here so they can raise more money. So preferred. Interesting. So I've had preferred stock for a while, and the values have fluctuated enormously. This is from 2018, the latest. Aha. Okay, so this is why you need to be ultra careful with companies that are issuing a ton of shares and debt. This is why you need to be careful when your company is when a company is massively overvalued and it's issuing preferred stock. Okay. Consolidated balance sheet data as of June 30th, 2018 are adjusted on a pro forma basis to give effect to the automatic conversion of all the outstanding ordinary shares and preferred shares into 851 million blah, 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 blah ordinary shares immediately prior to the completion of this offering. So essentially, this turned preferred stock into regular stock, and it diluted shareholders by almost 1 billion shares. That is one of the largest, off the top of my head, one of the largest dilutions I've ever seen. That is why their share count over here, where are we at here? Shares went down. Again, I'm assuming to the IPO from 848 million in 2017 to 332 million in 2018, and then that's why it went back up by about 700 million shares, is because they issued, well, they didn't issue in a sense, the preferred stock shareholders automatically converted, or their shares automatically converted into regular stock. That's why there is such huge dilution here. To give you some context, that means just from this share dilution that NIO shares from 2018 to 2019 and today in 2021, all else remaining equal, to 2018, which again, yes, doesn't happen in a real world sense, but just for the sake of this argument, dilute shareholders from 2018 to today by about 70%, which I can guarantee most of the time this means a company's stock has gone massively down because of this. Again, because I know that there's a massive bubble in the EV space, I'm assuming that their shares are way up since then. You are correct. So 2018, let's say they diluted shareholders back here at $9.90 per share. Since then, their shares are up 456% to $55 a share as of this writing, or as of this recording. Again, most of the time, and I think I illustrated this with, what's the other company that diluted shareholders? One of the other companies that I've already evaluated diluted shareholders massively, and I guessed that their shares went way down after that, and they did. and I can see, I think it was like a 97% share dilution, and I cannot remember the name of the company. I can see the chart in my head, but I can't think of the company. Okay, so again, normally I would read all this. I'll bore you to death. This is 371 pages. So yes, I'm not going to do that. Don't worry about that. So that is what happened there. So we figured one major thing out. But, okay, so this is a big problem. The retained earnings accumulated deficit. Again, I talked about this in a couple of videos briefly. I'm going to talk about a little bit more here. Retained earnings and accumulated deficit. When this is positive, it's retained earnings. When this is negative, it's accumulated deficit. Essentially, what these numbers show is the over time since the company, I think since it became a public company, the profit in retained earnings case, or the unprofitability in accumulated deficit case, the total profitability or unprofitability of the company since it became public. In this case, it's negative 50.3 billion CNY. That's how much the company's lost since it became a public company. That's where that preferred stock and share issuances and debt are going to keep this company alive while it works toward profitability. This can be an okay-ish thing if the company works toward profitability. In most cases, that's a gigantic if, but in this space with the huge bubble that's going on and the huge amount of investment that's going on in this arena, they may be able to stay alive long enough to where they can kind of fix that issue and rebalance it out by earning profits and then turning that into retained earnings. If they can do that, there'll be a gigantic success long term. If they cannot do that, they are going to destroy an enormous amount of investor capital. Okay, I'm on quarterly. Okay. Again, the loss is accelerating over time as they ramp things up. They're following, essentially what they're doing is they're following the Tesla model. Again, hoping they can hang on long enough to earn profitability like Tesla's done. Purchase of investments, 3 billion, 5 billion, 2 billion. I'd want to know what those are. If I were to invest in this company, proceeds from issuances of long-term debt, about 4.5 billion CNY. They partially used that to pay off old debt, and they made about a net total of 2.76 billion CNY, 2.76, which is about $430 million US dollars. Okay, nothing else major here. They're surviving on share issuances and debt issuances, which, again, if you're watching these videos, you know I do not like. That means they're surviving and, again, hoping to hang on until they can gain profitability, which worked really well for Tesla. Again, doesn't work well for most companies. If it does work out for them, they are going to be enormously successful. If it does not, again, they're going to destroy, what, $81 billion? Oops. $81 billion of shareholder capital as of this writing is what the market cap is. I can't talk about their valuation because, at least in a normal sense, because they are unprofitable in every single metric, so you can't look at valuation. What I can do, though, is I can compare this. Again, this is exactly what I would do. To show you and illustrate how unprofitable or how overvalued this company is. I can take you to here. So they have a sort this by market cap. Let's see here. What's a similar company of, whoa, that goes way up. Okay. So $80 billion. That is Altria. Let's go with them because I am very familiar with them. I'm used to invest in them. I've actually recently evaluated them not too long ago. So to illustrate this, this is what I would do. Again, for any stock I'm looking at, this is the exact process I would use. If there's no valuation metrics, stuff like that. So $81 billion market cap for NIO, $82 billion market cap for Altria. Let's see what their numbers are. So in the last year, in the last 12 months alone, Altria has produced $20.6 billion in revenue. Its entire history, NIO's produced that 25 billion-ish. 25. So that's about just under $4 billion in its entire history in revenue. But it's about the same value as Altria. It makes no sense. Let's take operating income. This is negative, what, 27, 31. Let's go 35. 35 billion CNY. So that's about negative $5.4 billion in operating profit. Again, in its entire history, going back to 2016, that it's lost, while Altria has produced in the last year alone almost $11 billion in operating profit. You can do this for every single number. You can do this for operating net income. You can do this for free cash flow. You can do this across the board, and it would come out about the same. In 1 year, Altria has made about double in terms of operating profit that NIO has in its entire history. And it's produced about 5 times more revenue in 1 year than NIO has in its entire history, but they're valued about the same. Makes no sense whatsoever. This, again, illustrates how overvalued NIO stock is. One more illustration of this is, again, let's go to this, the max one. It kind of hovered around 2018, 2019, 2020 until the pandemic hit and got more serious, and then its share skyrocketed. Why? Frankly, I don't know. As far as I know, NIO hasn't released a new car or massively good results since the pandemic. Their results have been slowly getting better. My guess is this is partially related to the what's it called, the people being bored or whatever due to the pandemic, so looking for stocks to buy type of thing. Because the valuation, again, makes no sense whatsoever. It was hovering between $4 and $10 for most of 2018, 2019, and 2020 up to May 5th, 2020, May 29th, 2020. And then its shares just started skyrocketing from about $3.30 at the open of the market on the 29th of May 2020 to $55 per share today. Again, not much great news. Yes, they are slowly improving, but they are still massively unprofitable. Massively unprofitable. Okay, I'm going to bring you back over here. Okay, so I hope this illustrated how massively overvalued NIO is. I hope I did a good job of that, because frankly, you're pretty limited when a company is unprofitable on all metrics because you can't show any of the metrics. And again, I don't use price sales literally ever, but I could tell just from that one metric that it was going to be overvalued, again, based on my knowledge of the EV space and also the my previous minimal research into this company. I knew they were going to be overvalued. I didn't know how much they were going to be overvalued. This, again, to do a full analysis of Altria and NIO together NIO, Altria would destroy them on all metrics. And maybe we'll do that in a future video, but frankly, I don't think it's worth it because all you have to do is look at just even a few of them. And in 1 year, Altria has done more in terms of good returns, actual fundamentals, not just kind of speculation, revenue, profits, cash flow, than NIO's done in its entire history. And it's not even close because NIO is massively unprofitable on a operating profit, net income, and free cash flow basis, while Altria is incredibly profitable. One of the most profitable companies in the world, actually, on a consistent basis. So, yes, it's not an exact apples to apples comparison. Altria has been around forever. There were cigarettes, and they have a steady income because they have addictive stuff. I get that. Yes, they have massive competitive advantage on. I get all that. But I wanted to give you some context into the absurd valuation of NIO. Yes, even though it's somewhat a startup, it's actually selling vehicles, massively unprofitable, but it's valued at about the same amount as Altria is, and it's much more profitable. Why is that important? Why do I keep saying profitability and cash flow? Because over the long term, companies are valued based on the profits they produce and the cash flow they produce. In the short term, yes, you can get away with that. Stuff like Tesla, Facebook back before it figured out its revenue model, stuff like that. But again, if you don't figure it out, you're going to lose a ton of shareholder capital. If you do figure it out, you're going to be successful. If you don't, you're going up in flames. So it's either huge success, huge failure. There's not really much in the middle for these kind of companies. So there's no way I'd invest in NIO. Again, I want a Tesla. I'm going to make Tesla my next car probably after my current car dies. Most likely going to be a Tesla. I want this space from a technology perspective to work. But from an investment perspective, there's no way I can invest in NIO. It's so unprofitable. There's so many risks. People forget now that Tesla's the third, fourth, fifth largest company in the world, that there were many times it almost went bankrupt. If they didn't have Elon Musk and his power and brand name, essentially, and his connections to raise money, they would have gone bankrupt multiple times. I don't even know who the CEO of or founder of NIO is. Do they have the same power as Elon Musk when it comes to raising capital and dealing with failure and dealing with near bankruptcy and dealing with essentially pushing your vision forward in the face of seemingly insurmountable adversity? I don't know. I highly doubt it because, again, I think there are frankly few people on Earth that are as persistent and as good at what they do as Elon Musk. So I highly doubt it, and that makes the company even more risky, because that is a huge reason Tesla has succeeded like it has until today, is because of Elon Musk and him being a force of nature, essentially. Without that, we're going to see what happens with NIO, but they could, again, succeed massively, fail massively. There's no way, to me, the only way you can invest in this is it's a pure speculation, which makes sense because the stock chart is insane. So, which, again, illustrates that there's a massive amount of speculation going on in the stock. So, I hope this helped. This is a little bit longer than I typically want to keep these, but I hope this was of value to you. And I wanted to explain everything as well as I possibly could, which is why I took more time on this video. Because especially with the preferred stock stuff, there was different stuff we don't talk about. So if I didn't explain something well enough, let me know in the comments below. If you want me to check out a stock for you, let me know in the comments below. I've already researched a bunch of companies, a bunch of stocks for people. This one was at the request of, I believe it was Javier L. Requested this on YouTube. If you want me to look at a stock, let me know. Javier, great case study, interesting. There's no way I'd invest in it right now. If you own a bunch of shares, you may want to cash out to get your profits, unless you plan on holding long term. But then again, there's so many risks that is insanely risky. So, if you want me to look at a stock for you, let me know in the comments below. The only stocks I will not look at are banks, because I don't evaluate them, and insurance companies, because you actually have to dig in their financials, their 10Ks, and those kind of things to be able to evaluate the company fully. Other than that, I'll look at a company anywhere from around the world for you. If you want to become a better value investor faster, Make sure to check out our free resources at the links below. You can get our 5 free gifts, including my valuation templates, which the full versions of these that we're going through. You can also get a free PDF copy of my book, How to Value Invest. And you can also get a free copy of our guide, 7 Tips to Picking Great Stocks and 3 Times You Must Sell. You can get those all for free below. If you're looking for more specific help on how to become a better investor faster from me, you can check out our information on our masterclass below this as well. If you're watching on YouTube, or if you're listening on the podcast, sorry, make sure to like, love, share, subscribe, all that good stuff. We really appreciate it. We also really appreciate a review, because the more reviews, views, and listens we get of our content, the more people we can help. Again, same thing on YouTube. Like, love, share, subscribe. We really appreciate all that. But make sure if you subscribe to hit the notification bell so you're notified anytime we're releasing new videos, and releasing videos all the time. But until next time, hope you have a great day. Talk soon.